Straight-line depreciation. Straight-line depreciation is a method of determining the depreciation expense of a long-term asset. This method is used when a company wants to have equal amounts of depreciation expense on the financial statements each year. The depreciation expense using the straight-line method is calculated by subtracting the salvage value from the asset cost, that then divide the difference by the useful life. The useful life of an asset is the number of years that the asset is expected to be used in a business. The salvage value is the amount that an asset is worth after the useful life has ended.
Double declining balance depreciation. Double declining balance depreciation is another method of calculating expense for a long-term asset. In this method, a large amount of expense is produced in the first year of operation, and the expense gets progressively smaller each year. For this method, first determine the straight-line rate by dividing 1 by the number of years of useful life. Next, multiply the straight-line rate by 2 in order to find the double declining rate. Lastly, determine the depreciation expense by first subtracting the accumulated depreciation from the asset cost to find the book value, then multiply that number by the double declining balance rate.
Units of production depreciation. When use of long-term assets fluctuates from year to year, units of production depreciation is the best way to account for depreciation. Instead of having the item depreciate constantly across periods, depreciation is calculated by how much the item has been used. To calculate depreciation with this method, you first have to come up with a way to measure the asset's productive capacity. To calculate annual depreciation, you will first take the difference of the asset's cost and salvage value, then divide by the total productive capacity measure that you came up with. You will then multiply this quotient by the units of production in that year to get the annual depreciation in a given year.